All right, Tony, who are you going to pull the pork on today?
I'm going to pull the pork on Cettire Group. I'm not sure how
Did
you
you work
pronounce
out?
it.
That was going to be my first question. Did you work out in your pulled pork how it's pronounced?
No, but apparently the CEO makes it rhyme with satire, according to Rear Window and the Feed. So,
Right. Well, that's what, when I was talking about it, I think it was last week, that's what I kept thinking. Is this supposed to sound like satire, or is it a satire? Because it seemed like a bit of a satire when I was the drop shipping company. All right. Anyway, I'll shut up, let you get into it.
okay, well, I'm going to call it satire. And I'm doing the pulled pork because we did speak about it last week and it was on the buy list. When I did my analysis, the share price had a bump to 55 cents, which is what I'm going to do my analysis on, which takes it off the buy list because it's at the bottom. But I did notice today it was back below 50 cents, which I think would put it back on the buy list because it's at the it's pushing up against the price to operating cash flow steps of greater than 7 times threshold. So below 50 cents, I think it's a buy. Above it, you might want to wait. So that's why it may not be on the buy list if you have a look at it when you hear this, but it was last week. And it's an interesting company. It's rare that we get a bit like Cisco. It's rare that we get. It's not a tech company, but it's a capital light business, which is the whole basis of internet retail. That put Amazon, etc., on the map. And this is one of those kinds of company which doesn't hold stock, as you say. It's a drop ship company. So I thought it was really interesting to do a pulled pork on it, and interesting to see it on the buy list. I've titled my pulled pork "How the Mighty Have Fallen" because the share price was $4.79 in February last year, and it's now around 50 cents. The analysis, as of yesterday, was 55. It's dropped again below that. If you look at the graph, it's a falling knife. So that's something to be aware of. The price has been going down, obviously, from that high to today's price, which is, 10% or thereabouts of what it was a year ago, or a little over a year ago. So that's a big drop. But the price did kick up above its buy line last week, so it is a buy on our buy list. I did talk about the article last week where there were some questions raised about by an investigative journalist about whether sales tax had been incorrectly charged for US shipments, and whether that was helping the bottom line of this company. That's all I'll say on that. You can, if anyone's interested, they can Google the relevant articles and the company's response to it. It's all pretty high profile stuff on the internet last year. The background to this company was it was launched in 2017 and it listed in 2020 at 50 cents a share, raising 65 million. So the share price is back to where it started. Market cap is up over 208 million, but the share price is back to where it started. The other thing to notice about this company and its share graph is that according to Stock Doctor, the company is held, or shares in the company is held heavily by short sellers. So it's something like 10% of outstanding stock has been borrowed and sold by short companies. Now, the interesting thing about this is that they would have started shorting it a little while ago during the drop from 479 down, and during the allegations of sales tax manipulations, rightly or wrongly. And it's possible, and I've seen this happen before, that the kick up in the price now is caused by what's called a short squeeze. So if someone's made a lot of money shorting the stock, they will eventually sell it and hand it back to the original owner and pocket the loss as a capital gain, if that makes sense. So the way short selling works is I buy it at 479, I wait until it gets to 47 cents, and I buy the stock back in. So I buy it at 479, I sell it, I keep those proceeds in my pocket, and when the price has dropped enough, I buy the stock back and hand it back to the person I borrowed it from, and I've made a tidy profit.
So that's why I was confused. You said 10% of the stock is held by short sellers. How can it be held by short sellers if they've sold it?
Well, they have to. It's not. You're right. It's not held by short sellers. The obligation is for them to return 10% of the stock, and to do that, they've got to buy the stock and then return the shares back to the person they borrowed it from.
How is that tracked? How does anyone know that? Is that reported somewhere when you have a short transaction?
Yeah,
Like
we spoke about
Right.
this last week as well. Again, Macquarie Group were pulled up by ASIC for not reporting properly their short transactions. So basically, if you're lending your stock to a short seller, I'm not sure who has to report it, but one side of that transaction, or if not both, have to report it to ASIC. And so ASIC can then make the market aware that there's a large amount or a little amount of short selling going on in this stock.
ASIC or the ASX?
I think it's ASIC. And I think I may have said APRA last week when we were talking about Macquarie. And
You did say
if I did, it was wrong. It's ASIC who does the tracking on this stuff, I'm pretty sure. So apologies for that. But yeah, I think
Right.
ASIC tracks this. And Macquarie Group, people can read about that, have been picked up for not reporting this stuff properly.
So, sorry, I cut you off. You were going to explain what a short squeeze is again?
Yeah,
dating a little person, but you're not referring to that.
No. So what happens is if the share price is bombed out, as this company's share price is, and it starts to rise again, it means that it's starting to erode the profits of the short sellers, and they basically jump into the market and buy shares to give back to the person they've borrowed them from. And that buying also forces the stock up. So it squeezes the remaining people who haven't bought and returned the shares to buy. And that buying alone can be enough to lift the price of a shorted stock. And you often see that when the short selling percentage declines, it's because the share price is going up, and it becomes a cyclical thing. The short sellers then make the share price go up because they're buying it to return the stock. So that's called a short squeeze, that kind of amplification of the upturn. So that's possibly where we are with this stock. Even so, I think it's probably below 50 cents. It's good value. So I think even if you're not worrying about the short side of things, it's certainly approaching fair value. Cettire, over its relatively short life, has shown strong revenue growth, and in some years there was a doubling in sales, and even as recently as 2023. It certainly got a kick along during COVID as people were not going out to shop; they were shopping more online. But in the 2024 calendar year, that slowed, and in fact, in the financial year, ending on the first half of the financial year for 2025, so ending in December, the sales growth was just 12%. So still good numbers for a retailer, but it's not doubling every year like it did at the start. So, and we've seen this before, even with Cisco, the people jump in on this growth stock. Its market cap's gone from $50 million, $60 million at listing, 65 to 208. Revenues doubled pretty much every year for the first 4 or 5 years, and people want to get in on this exciting growth stock. And of course, now that the growth is coming out of it, the price is dropped dramatically, and the PE is coming back to earth. So that's what we're seeing now. Still good numbers for a retailer, though. I mean, Kmart or Target or Myer or David Jones would love to have 12% revenue growth year on year. Company's based in Melbourne in William Street, where I first began my corporate life, working for Shell in William Street in Melbourne. So that's where this company's based. I haven't shopped with Cettire, so I can't comment on their service or their operational ability. When I went to their website, there was an awful lot of $500 T-shirts for sale, and I didn't really feel like forking out $500 for a white T-shirt, no matter who makes it and what brand they have on it. So I haven't shopped with them. It's not my cup of tea, but they do claim that there are nearly 700,000 active customers. And I think the key thing is a large portion of those live in the US. And that's part of what's going on to bring them where they are at the moment. Stock Doctor published a good analysis. I'm going to borrow from that. CTT is a global drop shipping online luxury retailer. Under the drop ship model, the business accepts customer orders without keeping stock on hand, allowing the business to generate strong cash flows without having high working capital requirements. The investment appeal lies with its low-cost operating model and back-end technology, which enables the company to facilitate an effective fulfillment order chain through the coordination of global logistics, customs compliance, managing product returns, handling payments, and fraud detection. In addition, luxury goods tend to be less sensitive to consumer behaviours from rising interest rates because high-end retail consumers benefit from the wealth effect. The business is led by a founder and CEO, Dean Mintz, who remains a large investor despite selling some of his shares in 22-23. Despite its high forecast return on equity and strong earnings growth prospects, our team, being Stock Doctor, has refrained from covering the stock due to the following risks: high levels of short interest, speculation that the company has not paid its share of import duties, low profit margins driven by high marketing costs, and that do not provide a margin of safety in the event of increasing competition. Consumer concerns around the authenticity of its products. So that's Stock Doctor's analysis, which I thought was a good summary. Back to the drop shipping model, the company claims to carry a virtual interest inventory of $2 billion. So that's the interesting thing, I think. They've got access to $2 billion of inventory, but they haven't had to pay for it until a customer places an order. Then they go out and buy that particular item and sell it. So when I think back to my days of retail, that would have been a huge benefit for a company like MyDirect that I worked in and ran, because it's really hard to balance your inventory levels if you're a retailer. And one of the reasons, because like you think about it, I don't know what's going to be on trend in 3 months' time. If Kim Kardashian wears a black dress down the runway and I've got a warehouse full of white dresses, they're not going to sell.
You know what the problem is, though, don't you? Albo's going to come and tax them on all the stuff they haven't sold yet.
Possibly an unrealized gain. Possibly. Well, that would be a loss, I think, in that case. But yeah. So anyway, so they've got a virtual inventory of $2 billion, and that's the magic in this style of company, that they don't have to fund that. They carry no debt, which is something which we like. It's on it's one of the reasons why it's on our buy list. The founder holds 33% of stock, despite selling down over the last couple of years. Still retains a lot. Looking at their latest results, now interestingly enough, they provided a Q3 sales update to the market on the 23rd of April, and that was for the quarter ending the end of March. Retailers don't normally provide quarterly updates. It's something you have to do in the US, not here. So I was interested why they were doing that, and I checked to see if it was a dual-listed company, but it isn't. So its sole listing is on the ASX. So I did wonder why they were making quarterly earnings reports, and all I could think of, my speculation, but I'm guessing that they liked the sales rises in the past being so high, and that they wanted to keep the market appraised of them. And if that was the strategy, it's come back to bite them, because in the last quarter, their sales rise was only 1%. And they also declared a loss for the quarter of approximately $4 million, which was blamed 50% on foreign exchange losses for the half. And they also went into some detail about US tariffs softening their demand. They did point out that 1% sales growth is better than the rest of the luxury brand market as a whole, which was going backwards. So they have managed to hold on to at least some sales growth. One interesting note when I was going through their presentation was that they report two sales lines. They talk about gross sales, which is revenue of $260 million, but then they talk about sales after returns, which is $192 million. So, and this was a similar pattern in terms of the ratio to prior periods. So 26% of their sales by dollar value have been returned. And that's a lot of work to do to process those returns. Plus, it's not a great customer experience necessarily, because someone's got to package up what they don't like and send it back to the company, and it's got to be put back through the system in reverse and credited and sent back to whoever they bought it off, if they can. Sometimes you can't do that. So I know, again, from operating in retail, returns are a net negative to the business. And we've never had anything like 26% of sales as returns at MyDirect. I can't remember what the number was, but it would have been probably single digits. So, if they can get that down, good. Look, it might be a positive that I know with the online retail business, if you don't know what your size is with this brand, it's the first time you bought a pair of shoes from that brand or a dress from that brand or whatever, you might buy 3 different sizes and try them on and then return the ones that don't fit. So there could be a bit of that going on, in which case it might be a good thing for the business, but it's certainly a big cost for that business. The other thing I want to focus on in analysing this business is tariffs. And tariffs have now come in, of course, for sales to the US. 43% of Cettire's sales are drop shipped from Europe to the US, and so they face tariff hikes. They report that only 4% of their sales are from China to the US, so that's where the worst tariff or the highest tariff hikes have happened. Even though they're on a 90-day pause, they're still high. But they are facing higher tariffs from the EU to the US. The other thing they're facing is what's called the de minimis law changes in the US. So the average Cettire sale to the US is $514. And up until now, that kept them below the de minimis threshold of $800 US. And for those listeners who don't know what that means, de minimis in Latin means too small to matter. And de minimis was an exemption applied to parcels generally shipped from overseas direct to a customer. And these packages didn't go through the warehouses and therefore are harder to regulate for customs, duties, and tariff charges. And back when de minimis was enacted 100 years ago or so, the logic was that the US government should not spend $1 to collect 50 cents. And that has been, I guess, the principle all the way along. And eventually the de minimis threshold went up to $200. And when Obama was president, he boosted it to $800, which kind of suited Amazon and other US companies starting to ship from the direct to retailers, often from overseas. And so it sits at $800 now. But on May 14th, President Trump included de minimis packages from China and Hong Kong in 135% tariff law, which is now on a 90-day hold and reduced to 54% during the whole period. So anything coming out of China and Hong Kong now faces 54% tariffs on even small parcels. So it's not a big chunk of change for Cettire at the moment because only 4% of their sales to the US come from China. But the Trump administration has flagged that they are going to work through packages from other jurisdictions, raising the tariffs on those as well. And the only thing that's stopping them from doing it now is that they can't physically process the trade from China and Hong Kong through the warehouses that the customs people have to put them through to be able to charge the right duties and tariffs on them. But once they get that sorted out, they'll start doing that. And to be fair to the current administration, Biden was also looking at the issue of de minimis parcels, largely from the point of view of that the US government suspects that the fentanyl trade from China was making use of the de minimis parcels that weren't going through customs inspections and sending drugs overseas. So that's certainly the argument, one of the arguments from Trump as to why the exemption's been removed from China. So if this de minimis change gets rolled out to the EU shipments, then Cettire will have a big problem, because if you glance at their website, they're usually offering about a 30% discount on what they claim is the retail brand price for a luxury item. If they then get hit with a tariff on de minimis parcels, which they're not being hit on now, then that discount goes away, which would affect them dramatically. So it is, as we said before, a volatile place at the moment, and Cettire has certainly faced some risks if you're thinking about investing in it from tariffs and de minimis changes. What do I think? I think that they might be short term. I wouldn't be surprised if someone works out how to get around that problem, and they might work out, for example, that shipping via Australia, which isn't currently subject to the minimis legislation, is cheaper than sending it direct from China to the US and paying the 54% tariff. So Cettire might may be able to work out a middleman or some other way of getting stock to customers without facing huge tariffs. But that hasn't happened yet. But it's certainly something for people to consider going forward, as I'm sure that the CEO of Cettire is thinking about now. Okay, so going on to the QAV numbers, the stock price I used was 55 cents. It is below that now, which puts it back on the buy list, but at 55 cents, it fell off the bottom of the buy list. 55 cents, though, is still 80% of consensus target. IV1 for this company using my methodology is only a cent, and there's no IV2 because there's no forecast EPS available. So we can't buy it for less than its intrinsic value. And that's due to the fact that this is one of the companies which has been profitable, but it's been using the profit to reinvest in the business and use marketing to expand its customer base. They are talking about changing that to try and maximize profit now, and it did make a loss in the last quarter, but at the moment it's IV using its earnings per share is only 1 cent. There's no dividend, so we can't score it for that. Stock Doctor financial health and trend is satisfactory and steady. Likewise, Stockopedia quality ranking is 92. So on the quality side of things, everyone likes it. However, Stockopedia ranked the company as 54 out of 100 for value and 5 for momentum, giving it only a total of 51 in the Stockopedia ranking universe. And that reflects the falling nice share price graph, I think. Likewise, the PE ratio is 194 times, given its low earnings at the moment. And that's the highest in 6 halves, so we give it a negative score for that. Prop CAF at 55 cents is 7.5 times, which takes it off the buy list. But when I looked this morning, I think the share price was back to 48 cents, so that would probably bring it back onto the buy list. There's an owner-founder who currently owns 33% of stock, and he did buy some more last year. He only bought 15 million, however. But that followed about $287 million in share sales in the 2 years prior to that. So he's certainly been raising red flags in the market, selling a lot of shares as the price has been dropping and the company was facing the spotlight of investigative reporting and issues with tariffs. Company doesn't have consistently increasing equity. It did up until last year, but we can't score it for that now. So overall, the score is 7 out of 13, or 54% for quality. At 55 cents, the QAV score is now 0.07, but it will be higher at 47 cents. I think, what can I say about this? I think Stock Doctor covered off the risks about it quite well. I think we've covered the risks of tariffs quite well. But, people are always interested in capital-like tech businesses. And so anyone who's interested in that might have a look at this. Otherwise, it's probably one to watch and enjoy the roller coaster ride, given all the uncertainty in that particular market going forward.
Wow. I was just looking at what price it was at on the buy list last week when I was going to add it to the light portfolios, and then I got the heebie-jeebies with it, and then talked to you, and you said, "Yeah, it's fine." But it was at 45 cents then, and then it went up to 60. And then now it's back down to 48 in a week.
Yeah, it's
volatile.
volatile, but it's also leading me to think it's the short squeeze that's driving the price up. Yeah.